How do you finance a multifamily or an apartment complex? I'm going to share with you some of the information that the lenders use to make a decision whether you're qualified to buy that property. So the first thing that they look at is how much income does the property generate? And what they're trying to measure there is, does it meet their debt coverage requirements? Now, most lenders are going to say, they're going to just ask you right off the bat, how much net income does it generate? Because they're in their mind noodling, okay, if you're going to ask me for a $1 million loan, I need this much in net operating income in order to meet my requirements. So let me give you an example. Most lenders want to make sure that a property generates a debt coverage of 1.3%. Meaning that for every dollar that you're going to ask the lender to give you for a loan, they want to make sure that that property is generating $1.03 above that in order to cover that. So how they calculate that debt coverage ratio is they're going to take the net operating income and they're going to divide that by the annual debt service, and that includes principal and interest. The taxes and the insurance are already factored in as operating expenses. So again, what the lender's going to do is they're going to take the net operating income and they're going to divide it by the annual debt service, and that tells them what the debt coverage requirement is for that property and what the property generates. And then it either meets the lender's criteria of 1.25 to 1.3% or better, or they're going to tell you that you have to put more money down in order to meet their debt coverage requirements. The second recommendation that I would recommend to you for financing an apartment complex is make sure that you're picking the right lender. It takes the same amount of effort from the loan officer to the underwriter, the appraiser, all the people that are involved with the loan process. It takes the same amount of effort whether you're doing a $500,000 loan or a $5 million loan. And several lenders have a minimum loan requirement of at least $1 million. So if you're trying to buy something at $1 million or less, you may want to look at using either a local credit union or a commercial lender that is a local bank in your hometown or in your area, because a lot of times they're looking for long-term relationships. They're looking for a deposit and a banking relationship, and in exchange for that, they're going to turn around and give you a $800,000 or a $900,000 loan. But again, most commercial lenders have a minimum threshold of $1 million. But again, don't let that deter you, because there's a lot of credit unions and local banks, those small commercial lenders that can meet your needs. And then the third aspect of financing a commercial property is the documentation. You're going to need a personal financial statement. Now, you can typically find those online, but most lenders have their own online financial statement that they want you to fill out. And luckily it auto calculates and it's pretty easy to fill out. So just ask your loan officer for their personal financial statement form that they want you to fill out. They're also going to ask you to supply your tax returns. If you're self-employed, they're going to want to see 3 years of your business tax returns. Now you may say, yikes, I have a problem with that. I write off a lot of expenses, so I don't show much income in my business. They may be able to use your business bank statements to supplement that or paint the story for the underwriter. I was a lender for 23 years, so I know that the loan officers work really hard to paint the right picture for the underwriter in order for the underwriter to say yes. So the more that you can communicate to your loan officer if you have concerns about being able to document your income with your tax returns and get ahead of that, then the lender can work with you and you can get through that process a little quicker. Also, anticipate that they're going to ask you to sign a personal guarantee. Now, what does that mean? That means that in the event, for some reason, that apartment stops generating the cash flow needed to service that debt, you agree that you personally will guarantee that debt. A lot of people buy property and put it in the name of an LLC. And one of the reasons that you want to do that is It protects the assets and the income for that property that's named in that LLC. But you're also still gonna have to sign a personal guarantee. Even if you put the property in an LLC, the lender is going to want you to sign that personal guarantee, because that shows commitment to the lender that you're saying, I'm good for the money. You trust me, and I guarantee you that that property will generate enough money to service the debt, as well as I personally will guarantee it. And then obviously you're gonna have things like fire insurance. So if for some reason you have a fire, then your insurance would kick in and it will help the displaced tenants and it will rebuild the property. And I will tell you, I have had many sellers who have had fires in their units. Things happen. Tenants accidentally put a couch too close to a heater, or they throw a blanket over a heater, or they start a fire in their kitchen and it gets out of control before they can get to the fire extinguisher. Stuff happens. So that's why you want to have good fire insurance and a good insurance plan in place, because that will also typically have a clause in there that the fire insurance company will help supplement your missing cash flow that you're missing while the builders are rebuilding that property. So the fourth thing that I want to talk about are the property types, because some commercial lenders want to see that you have a past experience in certain things like food and beverage, running a restaurant, opening a bar, if you're looking for that type of a loan. Where multifamily is a little easier because you've got a multitude of tenants that are paying you rent. So the lender looks at that and says, okay, this buyer is gonna hire a professional property manager to manage this property, and we've got all these tenants that are gonna be paying rent, it'll cover the expenses, we're willing to take this risk. But if you're a restaurant, as an example, and you have no experience running a restaurant, the lender's probably gonna tell you, I'm sorry, but we're not willing to make that loan at this point. So that's one thing that you want to consider before you get too far into a real estate transaction. Get pre-approved, start talking to a lender. I can recommend and refer you to multiple lenders that can meet your needs and answer your questions. You want a good lender that's knowledgeable about the local market and the local economy. They understand cap rates, they understand the market and what's happening, because they're going to be your best ally to help get you through the lending process. And you want to make sure that they understand the property that you're interested in and what your history and your experience is. If you have never owned an apartment complex, you should anticipate that the lender will want you to hire a professional manager, and frankly, I recommend it. It's not a great time to play amateur night. Even if you buy something like a duplex or 4 units, it's well worth the money to hire a professional management company. Right now is not a great time to put yourself into a precarious situation if you do not understand the landlord-tenant laws. You need to have an expert and an ally that's watching over you and over your property. So the lender will want you to hire a professional property management company to ensure that your rents are being met and that you are not in violation of any tenant landlord laws. Click on the link down below to download the free PDF, How to Sell Your Apartment for Top Dollar Fast. You can also sign up for my newsletter. I'm Rene Nelson with Pacwest Commercial Real Estate. Have a fantastic day.